Have you ever just stared at a market chart, with all those crazy peaks and valleys and just felt completely overwhelmed? It looks like total chaos, right? Well, the goal here isn't to give you some crystal ball to predict the future. It's to hand you a framework, a set of tools, and a new way of thinking to turn that chaos into a story you can actually understand. So let's learn how to read that story, starting with the one question every single investor asks themselves. It's the million-dollar question, isn't it? That little voice in your head, constantly nagging, is now the right time to buy? Is it time to sell? This urge to perfectly time the market, it's what drives so many of our decisions. And, let's be honest, a lot of our anxiety. Yeah, looking at a chart like this, it is so easy to feel lost. But here's the big mindset shift we're going for today. This is not random noise. Think of it like a language. In technical analysis, it's simply the skill of learning to read the story the market is telling us, a story about the constant, epic battle between buyers and sellers. So here's our game plan. First, we're going to tackle the whole idea of prediction itself. Then, we'll dive in and learn the basic language of the charts. From there, we'll build out our analyst toolkit, see how different markets connect to each other, and finally, we'll get into what might be the most critical piece of it all, the inner game of psychology. Okay, first things first. We have to completely reframe our goal. We are not trying to predict the future with 100% certainty. That's impossible, right? Our real objective is to use analysis to find high-probability scenarios where the odds are in our favor, and then manage our risk from there. So what's the real difference between what we're aiming for and just, plain old gambling? Well, a gambler is emotional. They're reactive, chasing some hot tip with no real plan. A trader, on the other hand, is analytical and systematic. They use a framework to find opportunities where the potential reward is worth the risk. It's the difference between just hoping for the best and actually executing a disciplined plan. All right, let's get into the fundamentals. If the market is telling a story, then candlesticks and key price levels, well, they're like its alphabet and grammar. Getting a handle on these building blocks is step one to becoming fluent in the language of the charts. So each one of these little bars is called a candlestick, and it packs a ton of information into one simple shape. The main thick part, the body, shows you where the price opened and where it closed for that time period. Those thin lines, we call them shadows, show the absolute highest and lowest prices it hit. A white or green candle means the price closed higher than it opened. That's a win for the buyers, the bulls, who are pushing the market up. A black or red candle means it closed lower, a win for the sellers, the bears, who are pulling it down.
And this is where it gets really interesting. Individual candles start to combine to form patterns that tell a much richer story. What you're looking at right here is a classic pattern called a shooting star. And when you see one of these after a strong move up, it's a huge warning sign.
So what's the psychology behind it? What's really going on? That long upper shadow tells us that during that period, buyers tried their best to push the price way, way up, but they couldn't hold it. Sellers came in with a ton of force and just slammed the price all the way back down. It's like a picture of a failed attack, and it suggests the bulls might be running out of steam. Now, the other crucial part of the chart's grammar are support and resistance levels. The easiest way to think about these is like zones of price memory. Resistance is a ceiling, a price where sellers have historically stepped in and pushed the price back down. And support is a floor, a price where buyers have historically shown up in force and stopped a drop. These are the key battlegrounds you have to watch.
So once you can read the basic language, it's time to build out your toolkit. You see, a single signal, like one candlestick pattern, is interesting. But professional traders, they look for multiple, confirming signals to build a really strong, high-conviction case for a trade. One of the most common tools in the box is the moving average. It's simple, really. It just calculates the average price over a certain number of days, say 50 days for the short-term trend or 200 for the long-term, and plots it as a single, smooth line on the chart. It cuts through all the daily noise and gives you a much clearer view of the underlying trend. Plus, they often act as moving support or resistance levels themselves. This quote perfectly captures one of the most powerful ideas in trading. It's a concept called confluence. The best setups, like Alan Farley says, happen when you have multiple different tools all pointing to the exact same conclusion. It's all about finding that alignment, building your case piece by piece. So how does this actually work in the real world? Let's build a case together. Okay, so here we see the price has pulled back to a rising trend line, which is acting as support. And right there, at that trend line, a bullish candlestick pattern forms.
That's our first piece of evidence. It's a potential reason to consider a trade where we bet on the price going up.
Now we add another layer, a moving average. And would you look at that? It lines up almost perfectly with our trend line, right in the same spot where the price is bouncing. So now we have two different types of support reinforcing each other. Our case is definitely getting stronger.
And for our final piece of evidence, let's look at volume. As the price bounces off this combined support area, we see a big spike in trading volume. This suggests there's real participation, real conviction from buyers. So we now have three independent signals, a candlestick pattern, a trend line, and volume, all telling the exact same bullish story. That, my friends, is the power of confluence.
So far, we've been really focused on analyzing just a single chart. But no market exists in a vacuum. To really get the full picture, we have to zoom out and understand how different asset classes, like currencies, bonds, and stocks, all influence each other. We call this inter-market analysis. A classic example of this is the relationship between the US dollar and pretty much everything else. As this chart shows, there's often an inverse correlation. When the dollar gets stronger, it can put a lot of pressure on things like commodities and even risk assets like crypto, mainly because it just makes them more expensive in other currencies. Watching the dollar can give you a huge clue about the entire market environment.
So what should be on your radar? Here's a quick cheat sheet of key macro indicators. You'll want to watch the DXY for the dollar's strength, the SPY, which tracks the S&P 500, to get a feel for the stock market's risk appetite, M2, which tracks money supply, and the CPC, or the put/call ratio, which is a great tool to measure overall fear and greed in the market.
We've covered chart reading, our toolkit, the big picture, but you can master all of that and still fail if you don't conquer the final and, frankly, the most difficult piece of the framework, your own psychology. Even the absolute best analysis can be completely destroyed by emotional decision-making.
One of the most dangerous psychological traps for any trader is confirmation bias. This is our very human tendency to look for evidence that proves we're right and to conveniently ignore anything that suggests we might be wrong. If you're bullish on something, you'll start seeing bullish signals everywhere, even if there's a mountain of bearish evidence staring you right in the face.
This quote just gets right to the heart of it all. A chart isn't just a bunch of lines on a screen. It's a map of human emotion. It's a constant tug-of-war between greed and fear. And mastering analysis means learning to read that emotional landscape without getting swept away by it yourself. So let's put it all together. This is your framework. It starts with learning to read the charts, the language of candlesticks and key levels. Next, you build out your toolkit to find confluence and confirmation. Then you zoom out to understand the big picture context by connecting the markets. And finally, the foundation that holds it all together, you have to actively work on mastering your own psychology. Because in the end, that's what this is really all about. We're not trying to predict the future. We are learning to read the present state of our collective human emotion as it's reflected in price. The real question is, are you ready to learn the language?